Have a look at this chart right over here. Will you be able to trade this chart? There is something fundamentally wrong with all SMC trading, but can you spot it? I'll give you 3 seconds to find out. The answer is this. There are too many buy and sell patterns on the chart. Things like this fair value gap over here signaling you to buy, that order block right over there that tells you to sell, another BPR that signals a buy, etc, etc. This is the problem with every single SMC strategy. You have too many places to buy and sell from that you can't make a proper decision. Every single choice that you make seems like a bad choice because you end up just not taking a trade. For this example, let's take a look at this specific area right here. The market makes a slight pullback to the bullish fair value gap right over here. And then you want to go in for a buy because we expect a bullish fair value gap to act as a support. Alright, cool. But then the market goes higher into this bearish fair value gap over here, which then again you're expecting to act as a resistance on price. So are you going to now sell at this price point? Now, if you do sell, weren't you already in buys early on? You're not going to be able to ride the wave higher with the buys right now. But at the same exact time, you see that this bearish fair value gap standing in your way, and you could argue that this is now a good time to look for some sells. This is the exact problem with all SMC strategies. Every decision that you make in the markets is met with another conflicting piece of evidence. And so therefore, you always feel lost and confused. So if you have felt this way before, don't worry, because in this video, you'll learn number 1, why the different SMC concepts are not made equal. Number 2, how to play on the right side of the market. Number 3, how to accurately determine your bias. That is the most important. And number 4, an SMC strategy to profit in bullish and bearish markets. Heck, I'll even give you a few indicators for you to use so that even a complete beginner can execute on this strategy. Now, if this is something you'll be interested in, smash the like button and hit subscribe. Let's get right into it. Number 1, why the different SMC concepts are not made equal. The reason for this is because of this thing called order flow. To understand order flow, we must first understand premium and discount arrays. Premium and discount arrays, or PD arrays for short, are key points in any price chart. Right here, we have the full list of the PD array. You have your old highs, old lows, rejection blocks, order blocks, fair value gaps, breaker blocks, etc. I know, it's a lot. So for this video, we'll be focusing on the 3 most important PD arrays that I use every single day in my trading. They are number 1, order blocks, number 2, fair value gaps, and number 3, old high and lows. Now, I'll be using terms like premium and discount arrays throughout this video, so I'll define them right now. Premium arrays are bearish confluences, meaning that these patterns should push price lower. Discount arrays, on the other hand, are bullish confluences, meaning that these patterns should push price higher. Back to the main point. What is order flow? In its simplest terms, order flow is PD arrays holding towards one side of the market. So let's take a look at this chart right over here. Here on the silver chart, you can see on the daily time frame, at this lower point of the chart, we have a bullish fair value gap created by the gap of the wick of this candle over here and this candle right over here. This is the bullish fair value gap that sends price higher, creating yet another bullish fair value gap in the process. We then retrace lower, creating a bullish order block in the process. You're probably asking, Nick, why is this a bullish order block? The reason is because it is the most recent sell to buy move within this price link. When price comes back to retest this bullish order block, price is sent higher, creating successive bullish fair value gaps past this swing high after retracing slightly. This is a prime example of bullish order flow, where your discount arrays are holding, pushing the market higher every single time price retraces back into these arrays. I also can already hear you asking, guys, Nick, what about the bearish order blocks that we have right over here? Or this bearish fair value gap right over here? Shouldn't it push price down even further? Now, when order flow is extremely bullish like we have right over here, these premium arrays barely affect the direction of the markets. I'll extend these markups to the right, and you can see right here that these premium arrays are what is causing the retracement or pullbacks to happen. These bearish order blocks was responsible for creating this retracement in this form of a down close candle, as seen right over here, which then later became a bullish order block to send price further up. This bearish fair value gap caused a minor retracement before ultimately pushing higher. If the underlying order flow of the market is bullish, then these premium arrays should not be utilized as points of interest to start selling. They are merely seen as areas where short-term pullbacks happen. Let's take a look at bearish order flow now. On this gold chart, you can see that after price pushed up higher for a while, we suddenly have a large bearish fair value gap created by the gap between these three candles here. This is a warning sign that order flow is switching from bullish to bearish. A new bearish fair value gap is then created right over here from the first one, and price is pushed further downwards. We then have an upward retracement with this candle here. Again, you will see that the cause of this retracement was because of this bullish fair value gap previously formed right here. Price then moved lower past this up close candle, making it a bearish order block. Price then retraced back up to this bearish order block once again, caused by a lower bullish fair value gap as seen here, before slamming lower again, creating another bearish fair value gap in the process. This fair value gap is then retraced into before continuing lower, creating yet again another bearish fair value gap, and this time, this new bearish fair value gap sends price even lower until we eventually hit the final target. So, similar to the point made previously, just flipped. If the underlying order flow of the market is bearish, then discount arrays should not be utilized as points of interest to start buying. They are merely just seen as areas where short-term pullback can potentially happen. Number 2, playing on the right side of the market. Now let's dive into knowing whether to focus on bullish or bearish order flow. Let's refer to this chart that we have already marked up and think back to the first chart example that I've shared. Do you notice that I place more emphasis on the right side of the market and place less importance on the left side? That's because we are trading current price action. Yes, it is important to be aware of the past price action. But if you're trading the current price action right now, you do not want to be focused on what has already happened on the left side. As mentioned before, I am aware of the previous bullish points of interest, but they are mainly used to identify areas where retracements or pullbacks should happen. This brings me to the next method of knowing when to pay attention to the different points of interest. The point of interest that you're using to trade off of should be in line with the market's current order flow. This, paired with paying attention to the right side of the chart, reduces a ton of confusion. For example, we have established that the underlying order flow of the market is already bearish, as our premium rates are being respected time and time again. When the market suddenly prints this bullish fair value gap right over here, is it logical to trade off that? No, because it is not in line with the market's bearish order flow. You can see it act as a temporary roadblock for price action to go lower, but eventually, price should break through it and push lower very aggressively. This brings me to the most important part of the video. Number 3, how to accurately determine your bias. Let's first define bias. Bias is simply the direction of the market. Are we bullish or are we bearish? So, how do we determine that bias? Creating a bias is like building a Lego set. You need to stack different Legos together. In that same way, to build a bias, you need to stack different confluences together to figure out the overall direction. There are bullish and bearish confluences. In other words, when you want to get a bias, all you're doing is leading a debate between the bulls and the bears. So how do we do that? Let's take a look at gold right over here. Starting on the weekly time frame, what can we see? Price has tested and pushed off a bullish fair value gap as seen right over here. This is a very strong bullish confluence because it is a weak fair value gap. Now, are there any bearish confluences? I would argue not really. Why? Because we don't really have a premium array holding price back. The last few candles has been extremely bullish, creating that bullish fair value gap. So, on a weekly time frame, we are looking very bullish, and our direction or bias is therefore bullish. Now, the question is, how do you trade when the market bias is bullish? We look to target the next premium array or bearish array. Things like your bearish fair value gap, order blocks, or session highs are price points where you should be looking to close out your positions. Right now, the market is heading towards the next premium array, which is this swing high right over here. Why? Because price has been trending higher, so it's clear that the direction is already bullish. And when the market is bullish, you typically want to target the next premium array. In terms of bullish versus bearish confluences here, we only really have bullish confluences at this point in time. That means for now, our bias will be bullish. Now, let's zoom into the daily time frame. This is where you will figure out your daily bias. We're going to do the same process of stacking our bullish versus bearish confluences against each other. At this moment in time, let's stack up the confluences we know thus far on a weekly basis. On the bearish side, we don't really have anything on the weekly time frame. On the bullish side, we have this weekly bullish fair value gap that we have plotted just now. Can we find any bearish confluence in the daily time frame? Yes, we have this bearish fair value gap right over here, created by these three candles, as well as the bearish order block created by this buy to sell move. Now, how many bullish confluences do we have? We still have that weekly bullish fair value gap that we are trading into. Now, remember, the weekly time frame is stronger than the daily time frame. So if you want to continue higher, then the weekly confluence will follow through. At this current point, there is no real bias on the daily time frame, since a weekly fair value gap and a daily fair value gap plus OB are roughly similar. If we now wait for a few more days of price action to play out, you can see that we have more bullish confluence stacking up, which is exactly what we want to see. Now let's weigh out the different confluences again. On the bullish side, first, we have the weekly fair value gap. Second, we have the daily low sweep right over here. Third, we are disrespecting the bearish fair value gap right over here. The reason why this is a disrespect because we are looking to create a body candle close past this high. And it has done so with this bullish candle right here. Next, as price is moving up, you can see price is leaving behind a bullish fair value gap, which creates a balanced price range or a BPR from the weekly fair value gap, which is price rejecting from the weekly fair value gap. For those of you who are not familiar, a BPR is when two opposing fair value gap overlaps each other like this. Now, that is 5 bullish confluences right over here, stacking on top of each other. Now let's move on to the bearish side. On the bearish side, we have this bearish order block. Yep, that's it. That's all. At this moment in time, which side is winning the debate? The bulls or the bears? Obviously, the bulls, right? All we did was stack up the different confluences against each other. And if we look at the probabilities, 5 bullish confluences versus 1 bearish confluence. So therefore, it is highly probable that we are going to go higher. Our probabilities are stacked towards the bullish side, which leads to us having a bullish daily bias. We have now successfully established our bias, which is of course bullish, just by leading a debate between the bulls and the bears. At this point, we can expect higher prices because the bulls clearly won this debate. Now, as you can tell, trading isn't about creating random SMC concepts on the chart. It is about waiting for actual PD arrays to form and trading off them. Part 4. The SMC strategy to profit in a bullish and the bearish market. Now, you might be wondering, this is cool and all, but how do I capitalize on this movement? How do I enter a position? We do the exact same thing, but on the lower time frame. Let's first go through over some step-by-step guidelines for this strategy. Step 1. Establish your bias. and mark out the final draw on liquidity or your target. We went through this in the previous section, but I'll make it clearer as we discuss some trade examples. Step 2. Identify the higher time frame point of interest we will trade off. This is usually a fair value gap or an order block. Step 3. Drop down to an even lower time frame to look for a balanced price range or a BPR. Don't worry, there's a simple indicator to help you with this. A BPR is simply two opposing, overlapping fair value gaps, like the ones we saw previously. This is not strict, but as a general guideline, use this time frame alignment. For the monthly time frame point of interest, you want to use a daily balanced price range or a BPR. A weekly POI, you want to use a 4-hour BPR. Daily POI, you use a 1-hour BPR. 4-hour POI, 15-minute BPR. 1-hour POI, 5-minute BPR. Step 4. Enter off the BPR using the time frame alignment that I've just mentioned, with stop loss placed at a swing low or high, targeting the opposing liquidity pool. Now, I mentioned that I have a few indicators that I can assist you in spotting out these confluences. So, right now, I want you to go to your indicator tab on TradingView and look for these indicators, and I'll explain exactly what they do. Number 1, fair value gap by ANCHE, ANCHE. This indicator helps you plot out fair value gaps in an instant, eliminating the need to draw out these fair value gaps by yourself. Number 2, liquidity levels MTF by Sona Labs. This indicator shows buy-side and sell-side liquidity on respective time frames. Buy-side liquidity is marked out with a blue line, and the sell-side liquidity is marked out with a red line. These liquidity levels are significant because they highlight price points where there are many pending stop and limit orders. These can help you identify take profit levels and stop loss levels in your own trades. If you're bullish, target the blue lines and set your stop loss at the red lines. If you're bearish, target the red lines and set your stop loss at the blue lines. I know that was a lot of information to take in, no worries, but it'll be more straightforward if I showed you how the indicators work in the trade examples later on. Now, with that being said, we've just covered the steps of the strategy. Let's go through a few trade examples. Let's first use the first example that we've already gone through. To quickly recap, we've established a bullish bias. We have 5 strong bullish confluences: the weekly fair value gap, the previous daily low sweep right over here, the disrespect of the bearish fair value gap, 4th, a bullish fair value gap is left behind, and finally, this created a balanced price range where the two opposing fair value gaps are overlapping, with price rejecting the weekly fair value gap. That is step 1 done. We also have the draw on liquidity, or simply said, a target in the form of this swing high right here. Step 2, identify the high time frame point of interest that we will trade off of. In this case, you can clearly see that we have a daily bullish fair value gap. So this will be the point of interest that we will trade off of. Remember, if you're using a daily POI, we drop down to the 1-hour time frame for an entry using the time frame alignment that we mentioned earlier on. Step 3. Now, this is where we're going to use the free indicator to find BPRs. Go to the top left-hand corner of your trading view and search for fair value gaps by ANCHE. Click on it and you'll be able to see all the fair value gaps marked out for you. Drop down to the lower time frame to look for a BPR. Again, I want to reiterate, since we have created a daily bias on the daily time frame, use the 1 hour to find an entry. There it is, 2 overlapping fair value gaps as shown by the indicator. That's our entry trigger. The last step is where liquidity levels indicator come in. We place a buy limit right here. Since we are bullish, we target the blue lines or the buy side liquidity and set our stop loss at the red lines or the sell side liquidity. So we'll place our stop loss here at the red line as marked out by the indicator. If price goes past this point, the long trade idea is invalidated. So this is a great place to put our stop loss. We will then target that daily swing high as the final target. Now let's see how price plays out. We hit our first target at this blue line. This blue line denotes the current time frame's buy-side liquidity. And this is where we will take partials and set our stop loss to break even. And as you can see, as price continues to run, it continues running higher, creating bullish fair value gaps in the process. This is where I would trail my stop loss to the newly created swing low. Let's see how the remaining position runs. There we go. Eventually, we hit our full TP, bagging us a 3.84 RR trade. Now let's move on to the very next example. Let's now take a look at the weekly USD JPY chart. What can we see? Price is currently reacting off a bearish fair value gap right here. So if we want to continue lower, we can continue lower off that. Now, are there any bullish confluences? There was this old bullish fair value gap here, which got disrespected. Now, why did it get disrespected? Because we had a body candle closure below it. So that means that this bullish confluence is negated. Over here, we have a long bottom wick. I would argue that this is a bullish confluence because it shows the intention of price moving higher, even if it's for the short term. I would say, right now, it is pretty even between the bulls and the bears. So let's zoom into the lower time frame. Right now, we're on the daily time frame. And I would argue that there isn't really much going on right here. There are no clear premium or discount rates to trade off. And of course, nothing really stands out to me. However, there is this long wick right over here. Now, this is a rejection block. A rejection block is a swing low or a swing high formed with a long wick. In this case, since this is a swing low with a long wick, this would be a bullish rejection block. I'll mark it out right here with a line. That can be a potential target if we are looking for potential shorts. Now let's further drop down another time frame. Now we're currently on the 1 hour time frame, and we can see that we have been aggressively moving lower with many 1 hour bearish fair value gaps coming off this weekly bearish fair value gap. We also have another bearish balance price range, BPR. So that's 3 strong bearish confluence right there. The weekly bearish fair value gap, the sequence of 1 hour bearish fair value gaps, and of course, the 1 hour bearish balance price range. Let's take a look at the bullish confluences. We have this huge bullish fair value gap on the left. The thing about this bullish fair value gap is that there are multiple smaller fair value gaps going into it, meaning this bullish fair value gap is failing to reject higher. Now, this would then negate any bullish confluences for me. This means that if we are going to continue lower, price would do so very fast. Overall, we have 3 bearish confluences and 1 bullish confluence. That gives us a bearish bias. The indicator has also marked out this sell-side liquidity pool right over here as a target. Now, don't forget the rejection block that we marked out on the daily time frame. That is step 1 done. Alright, now let's move on to step number 2. Identify the higher time frame point of interest that we will trade off of. We have a few options here. We have the weekly fair value gap or these 1 hour bearish fair value gaps right here, which we can just take a trade off. Let's use these fair value gaps right here since we are already on the 1 hour time frame. Step 3. Find a lower time frame, BPR. Since we are using the 1 hour point of interest, we drop down to the 5-minute time frame to find a BPR once we hit the 1 hour bearish fair value gap. Right there. 2 overlapping fair value gaps as shown by the indicator. For the last step, we place our sell limit right here with stop loss at this swing high at the higher blue line. This higher blue line is the buy side liquidity marked out by the indicator, which is a great place to place your stop loss. Price hitting this blue line would mean that shorts are invalidated, and if let's say we held onto this trade and price continued running towards the upside, we will just take even larger losses and losses and losses. And that's why having a stop loss at this high would reduce the amount of loss that we take if we are wrong. Our take profit will be targeting the 1 hour swing low as the final target, taking partials at this red line right over here, and then holding a runner to our final target. And as you can see, the full take profit smashed. Now, if lower time frame entries aren't your thing, and you prefer more swing trading style entries, you can always enter off the 1 hour fair value gap itself. Let me show you exactly how. The only thing that you have to change is the entry time frames. Since we have a 1 hour balance price range, we simply set a sell limit at the bearish fair value gap's low, with stop loss above the most recent swing high, targeting the swing low, which is the sell side, as given by the indicator as the first take partial area. As price continues to run, we can look to target the daily rejection block as the final target. Price dumped lower quite quickly, hitting our first target. This is where I will go break even. I'll take my partials and go break even at this point. Remember what I said about when we have no bullish confluence holding us back? Price would go fast? This is exactly what I mean. When we have no roadblocks on price, that's when price moves extremely quickly and smacks your full take profit just like this. Now that's a little gem for you. Now as you can see, price goes back and forth for a pretty long time and then finally delivers to our final target, the daily rejection block after a while. To wrap things up, we've covered multiple key concepts today that can help you navigate the markets with more clarity. First, remember that not all SMC concepts are equal. Understanding the order flow and distinguishing between premium and discounteries will make all the difference. Second, always focus on playing on the right side of the market. Literally. Always prioritize current price action and ensure that the point of interest that you're trading aligns with the market's order flow. This reduces confusion and improves decision making. Third, accurately determining your market bias is extremely crucial. Stacking up bullish and bearish confluences help you make informed decisions. Last but not least, we went over a step-by-step strategy to profit in both bullish and bearish markets, with some useful indicators to assist you. Every single step is key in building up an overall narrative for the trade. Do not skip out on any steps and follow the criteria as I've laid out for you for the best possible results. Of course, if you found this video helpful, make sure to hit that like button and subscribe for more content. And let me know down in the comment section below if you're applying these concepts to your trading. Keep practicing and I'll see you in the next video. Nick signing out.